Picture this. In the year 2026 alone, the world's 5 tech giants, Amazon, Google, Microsoft, Meta, and Oracle, are set to pour a staggering $602 billion into AI infrastructure. Let that number sink in for a moment. This is not a multi-year projection. That's just for 1 year. Yet, while this avalanche of capital flows into servers, chips, and data centers, the revenue from AI-specific services isn't even close to keeping up. In fact, for every dollar these companies spend on AI hardware and infrastructure, they're only generating about 10 cents in return. AI-related services are expected to rake in just $25 billion in revenue in 2025. This jaw-dropping mismatch is sending shockwaves through the entire tech and investment community. It's a capital gamble on a scale we haven't seen since the last great technology booms. The question on everyone's mind, will this massive bet on artificial intelligence pay off, or are we witnessing the early stages of a financial bubble that could burst and send ripples across global markets? In the next few minutes, we'll break down the numbers, the risks, and the enormous implications for anyone invested in the future of technology. Let's take a closer look at the numbers driving this urgency. The major tech companies are collectively spending at an unprecedented rate on AI infrastructure. However, the revenue from AI services is lagging far behind. To put it simply, they're spending $10 for every $1 earned from AI-specific products and services. Imagine running a business where your costs outpace your income by a factor of 10. No CEO would accept that for long unless they expect a massive payoff in the future. And that's exactly the gamble being made. This isn't just about short-term losses. These companies are betting that AI will fundamentally transform the economy, and that the eventual revenue streams will dwarf today's numbers. But for now, the financial picture is stark. The most successful tech companies in history are plowing billions into assets that, at present, bring in only a fraction of what was spent. This dynamic is creating tension among investors and analysts who are starting to question how long such spending can be sustained without a clear path to proportional revenue. Every figure and claim in this analysis comes straight from the most reputable sources in finance and technology. We're relying on data from Bain Capital, Goldman Sachs, TD Cowen Research, Data Center Watch, and official earnings call transcripts. There's no guesswork here, just hard numbers verified by the world's leading analysts and research firms. That means when we talk about the $602 billion capital expenditure, the $25 billion in projected revenue, or the $800 billion gap between what's needed and what's likely, those aren't speculative figures. These are numbers that have been checked and rechecked by top-tier investment banks and industry observers. So whether you're a retail investor, a tech enthusiast, or simply someone trying to understand the future of AI, you can trust that these insights are grounded in rigorously sourced evidence. This careful approach is crucial, especially when we're discussing trends that could reshape markets and impact millions of jobs worldwide. In an environment full of hype, it's the grounded facts that matter most. So, is all this spending a classic sign of a speculative bubble, or is it simply the necessary groundwork for a new era of technology? This is the crucial question facing everyone from Wall Street to Silicon Valley. On one hand, the rapid escalation of capital expenditures, far outpacing current revenues, echoes historical periods of overinvestment, like the dot-com bubble of the late 1990s. On the other, some argue that this is just what it takes to build transformative infrastructure. After all, the digital economy would not exist if the fiber optic cables of the 90s hadn't been laid down years before demand caught up. The distinction between a bubble and a build-out often comes down to whether future revenue justifies today's massive investments. If AI delivers on its promise, these outlays could look visionary. But if growth falls short, the losses could be staggering and widespread. Investors, executives, and analysts are all grappling with this uncertainty, trying to predict whether history will repeat itself or if this time truly is different. Let's break down exactly how much each tech titan is spending on this AI arms race. Amazon has increased its 2025 capital expenditure target to an astonishing $125 billion, a 61% jump over the previous year. Google has adjusted its own 2025 capex forecast upward not once but 3 separate times, finally landing at $92 billion for the year compared to $52.5 billion in 2024. Microsoft is spending at a blistering pace, with $34.9 billion spent in just one quarter and an $80 billion commitment for the current fiscal year's data center expansion. Meta is projecting $70 to $72 billion for 2025 and expects to surpass $100 billion in 2026. Even Oracle, a company historically less flashy in spending, is now part of this spending surge. When you sum it all up, the 5 hyperscalers are forecast to reach $602 billion in capital expenditure for 2026. To put that in perspective, this figure represents a 36% increase over 2025's already record-breaking spending, which itself was a 73% leap over 2024. These are numbers that dwarf previous technology investment cycles and highlight the breakneck speed at which companies are trying to claim their piece of the AI future. The pace at which these tech giants are ramping up their capital expenditures is truly historic. In just 2 years, the combined capex of the 5 hyperscalers is expected to rise by 73% between 2024 and 2025, and then by another 36% in 2026. According to projections from Goldman Sachs, total capital investment from 2025 through 2027 will reach a mind-boggling $1.15 trillion. To put that in context, this is more than twice the $477 billion spent during the previous 3-year period. The scale and acceleration are without precedent, even compared to other major waves of technology investment. For reference, Microsoft alone spent nearly $35 billion in a single quarter, numbers that would have been inconceivable just a few years ago. This surge is not just about building more data centers, it's about an all-in bet on the future capabilities of AI. Every dollar spent today is predicated on the belief that demand will skyrocket and justify these investments. But the sheer magnitude and speed of this capital deployment are sparking debates. Are we witnessing visionary leadership, or is this a dangerous overextension?
To fully grasp the enormity of this spending, we need historical context. By 2030, these 5 hyperscalers are forecasted to add $2 trillion in AI-specific assets to their balance sheets. This dwarfs even the legendary telecom build-out of the late 1990s and early 2000s, when companies spent over $500 billion laying fiber optic cables in anticipation of future internet demand. Back then, much of that capital was wiped out when the dot-com bubble burst, even though the infrastructure ultimately powered decades of digital growth. Today's AI spending spree is of a much greater magnitude and is happening over a much shorter time frame. For perspective, current technology equipment and software investment in the U.S. reached 4.4% of GDP in 2025, almost as high as the dot-com bubble's peak. The S&P 500's valuation has even hit levels not seen since that era. This time, though, the assets being built, AI data centers and GPU clusters, are depreciating far more rapidly than the fiber optic cables of the past, making the risk window even more compressed. The stakes are enormous, and the outcome will shape the next era of technology and finance.
But here's the core problem. Despite all this massive infrastructure spending, the revenue being generated from AI services falls far short of what's needed to justify the investment. In 2025, AI-related services are projected to bring in $25 billion across the entire ecosystem. OpenAI, the company at the heart of this build-out, is expected to generate about $13 billion in annual revenue, yet it's still operating at a loss and doesn't anticipate profitability until at least 2029 or 2030. And it's not just OpenAI. Fewer than 3% of global consumers pay for any AI service, and less than 20% of enterprise AI pilots ever make it to full-scale deployment. An MIT study found that 95% of corporate generative AI projects never even reach production. The demand is real, but it's growing linearly, while the infrastructure spend was predicated on exponential demand. This mismatch creates a troubling gap, one that could spell big trouble if AI adoption doesn't accelerate dramatically in the coming years. Let's talk about depreciation. the hidden cost that could make or break the AI infrastructure story. All those servers, GPUs, and data centers being installed today lose value rapidly. AI assets, especially the GPU clusters at the heart of these systems, typically depreciate at a rate of about 20% per year. With $2 trillion in AI assets projected by 2030, that means the annual depreciation expense alone could hit $400 billion, more than the combined annual profits of Amazon, Google, Microsoft, Meta, and Oracle. This is not a minor accounting detail. It's a massive recurring cost that eats into earnings every single year. These companies are essentially racing against time, betting that AI revenue growth will accelerate fast enough to offset the relentless erosion of asset value. If they fall behind, the financial impact will be brutal, potentially wiping out profits for years on end. It's a ticking clock, and Wall Street is only just beginning to price in the full risk. Now let's zero in on the most critical component, GPUs. Unlike traditional infrastructure assets, which might last 20 years or more, GPUs are on a much faster depreciation schedule, often just 3 to 5 years. NVIDIA, the dominant player, releases a new chip architecture annually, which means today's top-of-the-line GPU clusters become outdated almost as soon as they're installed. This relentless pace creates a unique risk. If enterprise AI adoption takes longer than expected to ramp up, the expensive hardware purchased today could lose most of its value before it's ever fully utilized. The risk is compounded by the $1.5 trillion in projected new debt the sector is taking on to finance this build-out. If the anticipated revenue surge doesn't materialize quickly, companies could find themselves trapped between maturing debt payments and rapidly depreciating assets. In short, the AI infrastructure story is not just about technological ambition. It's also a race against the depreciation clock, and the consequences for investors could be severe if timing doesn't line up perfectly. One of the defining features of the current AI infrastructure boom is just how capital-intensive it has become. Unlike traditional software businesses that require relatively minimal upfront investment, the construction of massive data centers, procurement of GPUs, and securing consistent electricity supplies demand vast sums of cash upfront. For example, Microsoft, Amazon, and Meta are collectively spending hundreds of billions annually just to build out and maintain their AI infrastructure. However, this enormous capital outlay does not translate directly into proportionate revenue. The return on these investments is often delayed, with cash flows lagging behind the rapid pace of expenditure. This creates a critical tension for these tech giants. They must continue injecting cash to stay competitive, even as the money flowing back in is inconsistent and often unpredictable. Companies are effectively betting that future AI demand will catch up before their hardware becomes obsolete. But this is a risky game, especially when depreciation cycles for GPUs are only 3 to 5 years. If demand growth doesn't materialize fast enough, these upfront costs could turn into massive sunk costs, putting significant pressure on corporate balance sheets. Companies are effectively betting that future AI demand will catch up before their hardware becomes obsolete, but this is a risky game, especially when depreciation cycles for GPUs are only 3 to 5 years. If demand growth doesn't materialize fast enough, these upfront costs could turn into massive sunk costs, putting significant pressure on corporate balance sheets. Host. As the AI infrastructure race heats up, companies are increasingly turning to debt to fund their massive capital expenditures. Between 2023 and 2025, annual debt issuance linked to AI and data center projects ballooned from $166 billion to an astonishing $625 billion. This surge in borrowing isn't limited to the tech giants. Specialized financing structures, such as asset-backed securities tied to data centers, have multiplied nearly 20-fold in just a few years. Meta's $30 billion Hyperion data center campus is financed through a special-purpose vehicle managed by Blue Owl Capital, keeping much of the debt off Meta's main balance sheet. While these financial maneuvers enable companies to move quickly and outspend competitors, they also introduce significant risk. If projected cash flows fail to materialize, these complex debt structures can unravel rapidly, leading to cascading financial stress across the sector.
The growing reliance on leverage is a double-edged sword. It accelerates growth in the short term, but leaves companies exposed if AI-related revenues don't meet expectations. The debt-fueled expansion could amplify any downturn, making the consequences of a slowdown far more severe than in previous tech cycles.
Host on screen. The explosion of debt financing in the AI sector has started to raise red flags within the broader credit markets. Analysts are beginning to notice warning signs reminiscent of past speculative bubbles. For instance, the proliferation of asset-backed securities tied to data center assets has drawn comparisons to the mortgage-backed securities that fueled the 2008 financial crisis. If AI-generated cash flows fall short, these securities could quickly lose value, triggering a wave of defaults and financial instability. Furthermore, several companies in the AI supply chain, such as CoreWeave and Oracle, are now highly leveraged, with their business models heavily dependent on the continued flow of hyperscaler and startup demand. SoftBank, after its $40 billion bridge loan to OpenAI, saw its own shares tumble nearly 45% from their 2025 peak. Such concentrated risk means that any disruption in the expected demand for AI services could ripple through the financial system, potentially impacting not just tech companies, but also the banks and investors who have bet heavily on this trend. The credit market's growing unease is an early signal that the sector's debt-fueled expansion may not be sustainable without substantial, consistent AI revenue growth.
Host. Despite the enormous sums being invested in AI infrastructure, the revenues generated by AI services have so far lagged far behind. For instance, in 2025, total revenue from AI-related services is expected to reach around $25 billion, a fraction of the $602 billion set to be spent on infrastructure in 2026. OpenAI, through its ChatGPT platform and enterprise partnerships, has been one of the few AI companies to report substantial sales, with annualized revenue hitting $20 billion by early 2026. Enterprise adoption of AI is increasing, but even the most optimistic industry forecasts suggest that AI revenues could reach $1.2 trillion by decade's end, still far short of the $2 trillion needed to justify current levels of investment. This creates a significant gap between infrastructure outlays and actual monetization. Companies like Microsoft and Oracle are dependent on large, often renegotiated contracts with AI leaders such as OpenAI to fill their pipelines, but the sustainability of such deals remains uncertain. The industry is betting on exponential demand materializing, but so far, real-world revenue growth is much more modest, putting immense pressure on the business models underpinning this historic infrastructure build-out.
While headlines trumpet the rapid adoption of AI, the reality inside most enterprises is more complicated. Many companies have launched pilot projects or proof-of-concept initiatives, but the majority have struggled to scale these efforts into full production systems that deliver measurable returns. In fact, current data shows that only about 25% of enterprise AI projects have met their expected return on investment. The reasons vary. Technical complexity, integration challenges, and a shortage of skilled staff frequently stall progress. In some cases, the anticipated productivity gains simply haven't materialized, leading to project cancellations or indefinite delays. This disconnect between hype and actual performance is causing some firms to pause further AI investments until clearer business value is demonstrated. Even giants like Amazon and Google face hurdles as they try to translate AI pilots into sustainable business outcomes. The high failure rate of enterprise AI initiatives underscores the risk that much of today's infrastructure investment may not yield the anticipated economic impact, at least not as quickly as optimists predict. Host. A critical mistake fueling the AI investment frenzy is the widespread assumption that demand for AI services will grow exponentially, matching the pace of infrastructure build-out. In reality, enterprise and consumer demand tends to grow much more linearly, especially for transformative technologies that require significant organizational change. For example, while cloud computing and smartphones eventually saw rapid adoption, their early growth was gradual, giving infrastructure time to catch up. With AI, many forecasts are based on the idea that usage will suddenly skyrocket, but current adoption curves suggest a slower, steadier climb.
This disconnect can lead to overbuilding, where capacity far outstrips actual use for years. If infrastructure is scaled to match aggressive exponential projections, but revenue growth remains linear, companies are left with stranded assets and underutilized resources. This dynamic is particularly dangerous when hardware depreciates quickly, as is the case with AI GPUs. Misaligned expectations between growth assumptions and actual market uptake could turn today's massive capital investments into tomorrow's financial liabilities.
Even top industry leaders have begun to sound the alarm on the risks of overbuilding in AI. Sundar Pichai, CEO of Google, has publicly stated that the sector is at risk of creating an AI infrastructure bubble where massive investments outpace genuine market demand. He cautions that the drive to build ever more data centers and deploy new GPU clusters may result in significant amounts of unused capacity, especially if enterprise adoption slows or shifts direction. Pichai's warning is particularly striking given Google's own aggressive capital expenditure increases, which have been revised upward multiple times over the past year. His assessment is echoed by other tech executives and analysts who recognize that even the most innovative companies face limits on how quickly new technology can be absorbed by the market. By acknowledging the possibility of an overbuild, Pichai is urging both investors and industry peers to temper their expectations and consider the potential for a correction, where excessive infrastructure spending could lead to sharp declines in asset values and stock prices.
The current surge in AI infrastructure spending is drawing clear parallels to the dot-com and telecom booms of the late 1990s and early 2000s. Back then, telecommunications companies invested more than $500 billion in fiber optic cables and network infrastructure, betting on exponential internet growth. While the demand for bandwidth eventually arrived, the financial collapse of major players like Global Crossing and WorldCom wiped out shareholders. The Nasdaq plummeted nearly 80% between 2000 and 2002. Despite the market carnage, the infrastructure built during that era laid the foundation for the next 2 decades of the digital economy. Today, the AI build-out resembles those historic bubbles. Capital is being poured into physical assets that may only be fully utilized years down the line. History shows that while technology can ultimately win, the investors who fund the initial infrastructure often face devastating losses. The real beneficiaries may not be today's AI infrastructure giants, but future companies that leverage cheap, already built resources to launch profitable applications, just as Amazon did with cloud computing after the dot-com bust. One of the most critical differences between the AI infrastructure cycle and previous tech booms is the timeline for capital destruction. In the dot-com era, fiber optic cables could be depreciated over 20 years, giving companies time to recover some of their investment. In contrast, AI hardware, especially GPUs, has a useful life of just 3 to 5 years. This means that if the anticipated demand for AI services fails to materialize quickly, the value of these assets can evaporate almost overnight. Already, there are signs that this rapid depreciation could collide with debt maturities and weak cash flows, creating a high-risk window between 2026 and 2028. During this period, the first major wave of GPU clusters will become obsolete, just as repayment obligations come due. If enterprise adoption or AI monetization falls short, a cascade of write-downs and credit events could follow. Analysts now identify this compressed timeline as a key vulnerability, making it essential for investors to closely monitor both technology adoption rates and the financial health of AI infrastructure players. Host. A wave of data center project cancellations and delays is now signaling a shift in market dynamics. As of June 2025, more than 36 major data center projects representing $162 billion in investment have been blocked or seriously delayed, often due to power supply constraints or shifting customer demand. Microsoft, for example, has quietly walked away from over 2 gigawatts of planned data center capacity both in the US and Europe, citing facility and grid connection delays. Amazon Web Services has also reconsidered some projects, while Meta and Google have opportunistically picked up abandoned leases.
Importantly, these cancellations do not mean the need for AI infrastructure has vanished. Rather, they show how volatile and competitive the landscape has become. Project timelines are now dictated as much by power grid limitations and regulatory bottlenecks as by actual market demand. The reallocation of capacity among hyperscalers illustrates a game of musical chairs, with each company racing to secure the best sites and power contracts. These developments highlight the growing gap between AI ambition and the real-world constraints of energy, logistics, and permitting. The data center sector's challenges serve as a warning that future AI infrastructure growth may be slower and more erratic than many expect.
Host stands in front of a digital map, highlighting regions with major data center developments. As AI infrastructure expands at a historic pace, the physical limits of the electrical grid have become a central concern. In 2025 alone, over 36 data center projects, amounting to $162 billion in investment, were either postponed or outright canceled, largely due to power shortages and grid bottlenecks. This isn't just a technical hiccup, it's a systemic constraint that threatens the entire AI boom. For example, in Northern Virginia, one of the world's largest data center hubs, utility providers have issued warnings about the inability to meet new capacity demands for the next several years. Similar issues have emerged in West London, Frankfurt, and Singapore. These bottlenecks highlight the paradox. Even as capital floods into AI hardware, the underlying infrastructure, transformers, transmission lines, substations, cannot be scaled up quickly enough to match digital ambitions. The grid's physical constraints have become the first real check on runaway AI expansion, forcing a reckoning between technological aspiration and electrical reality. This is not just a question of money, but of physics, geography, and regulatory timelines.
The host shifts focus to the intersection of technology and utilities, explaining how the world's tech giants are increasingly resembling power companies. With data center energy demand skyrocketing, companies like Amazon, Google, Microsoft, and Meta are now some of the largest private electricity consumers on the planet. Their AI ambitions have forced them to negotiate directly with utility providers, secure long-term renewable contracts, and even invest in their own grid infrastructure. For example, Amazon has signed deals to purchase gigawatts of renewable power, while Microsoft has funded battery storage projects to stabilize energy supply for its data centers. In Ireland, Google has been asked to defer new data center construction due to grid strain. These developments signal a radical shift. Tech firms are no longer just buyers of energy, but are acting as quasi-utilities, shaping energy markets and grid planning. This new reality has far-reaching implications. It means tech companies must now manage not only software and servers, but also the complex logistics of power procurement, transmission, and reliability, responsibilities traditionally reserved for regulated utilities. The tech sector's hunger for energy is beginning to reshape the entire energy landscape, raising questions about sustainability, regulation, and who ultimately bears the risks.
The host now addresses a less visible but increasingly critical feature of the AI infrastructure surge: circular financing and artificially created demand. As capital pours into the sector, some of the riskiest bets are being placed on companies whose business models depend on a web of interlinked investments and pre-arranged contracts. Take CoreWeave, which went public in March 2025. Its revenue is almost entirely derived from hyperscalers and AI startups, entities that are themselves intertwined through cross-investments and multi-layered agreements. This means a significant chunk of the demand for AI compute is not fully organic, but in many cases manufactured by intricate financial relationships. The same pattern is visible in how SoftBank, after extending a $40 billion bridge loan to OpenAI, pushed its own leverage to record highs, only to see its stock price plummet by 45%. Oracle, too, faces mounting risks, having committed $300 billion to OpenAI on terms that may not yield returns for years. The domino effect is clear. When demand is propped up by circular arrangements rather than genuine market need, the entire chain becomes fragile. If just one link falters, if startups default, or if projected adoption fails to materialize, the impact can ripple through the sector, exposing underlying vulnerabilities.
The host pivots to the subject of technological breakthroughs, focusing on the so-called DeepSeek shock, a moment when a major efficiency leap in AI hardware or algorithms dramatically changes the economics of the industry. Every few years, a breakthrough disrupts the expected depreciation curve. For instance, a new chip architecture might double performance without increasing energy use, or a software optimization might cut computational costs in half. The DeepSeek shock refers to a recent leap in AI model efficiency, which caught both investors and engineers off guard. Suddenly, hardware that was expected to deliver a set return over 5 years now faces obsolescence after just 2. This rapid advancement not only accelerates depreciation schedules, but also undermines the projected cash flows used to justify massive capital investments. Companies find themselves in a race, not just to build, but to avoid being stranded by the next leap in efficiency. The lesson? When technological progress outpaces financial planning, even the most carefully constructed business models can unravel. The DeepSeek shock is a vivid reminder that in AI, the ground can shift overnight, transforming yesterday's strategic asset into tomorrow's sunk cost. Turning to financial mechanics, the host explains the implications of the depreciation clock, the ticking timer that determines how long AI infrastructure remains economically viable. Unlike software, which can be upgraded at low marginal cost, physical AI assets, GPUs, custom chips, server racks, lose value rapidly as new generations emerge. In the AI data center gold rush, most capital expenditure models assume a useful life of 3 to 5 years per generation of hardware. But in reality, depreciation is accelerating. The first major wave of GPU obsolescence is set to hit between 2026 and 2028, precisely when much of the associated debt matures. This convergence creates a high-risk window. Companies will face ballooning interest payments just as their flagship assets become outdated. If revenue growth fails to keep pace with depreciation and debt service, balance sheets can deteriorate quickly, leading to fire sales, write-downs, or even bankruptcies. The depreciation clock isn't just an accounting detail, it's a financial reality that could trigger cascading failures across the sector. For investors, the timing of this risk window is critical for judging both short-term volatility and long-term value retention.
The debate over whether AI infrastructure investment is a bubble or a long-term value play is now reaching a fever pitch. On one side, critics argue that excessive optimism and circular financing are inflating valuations far beyond what current cash flows justify. They point to high-profile investors like Peter Thiel and Michael Burry, who have liquidated NVIDIA positions or taken bearish bets, as evidence that risks are underappreciated. Nobel laureate economist Daron Acemoglu and recent studies show that most firms have not yet realized measurable productivity gains from AI, even as executives forecast major improvements. On the other side, major banks like Goldman Sachs and Morgan Stanley counter that the current price-to-earnings ratios for tech leaders are well below dot-com bubble extremes, and that the largest companies have cash reserves and cash flow strength far exceeding past speculative cycles. They highlight real enterprise adoption, as evidenced by OpenAI's $20 billion in annualized revenue and Anthropic's $380 billion valuation. The host emphasizes that this is not a simple binary, bubble or not, but a question of timing, risk distribution, and which players are best positioned to weather volatility or benefit from the eventual value unlock.
Zooming out, the host places the current AI infrastructure cycle within the context of history, asking who typically wins and who gets left behind when a technology boom runs into hard limits. Looking at railway mania in 19th century Britain, investors lost their shirts as stocks crashed over 65%. Yet the physical railroads became the backbone of economic development for decades. The dot-com era saw telecommunications builders collapse financially, but their fiber networks enabled the rise of giants like Amazon and Google. The pattern is clear. The initial investors who chase infrastructure often bear the losses, while the real winners are those who later build applications or services on top of cheap, depreciated assets. Today's AI build-out may follow this script.
The companies pouring billions into AI hardware may not be the ones to profit most in the end. Instead, future startups, using already paid-for compute, could capture the next wave of value. The lesson is both sobering and empowering. Technological progress endures, but capital structure determines who prospers versus who absorbs the risk. Wrapping up, the host delivers 3 essential takeaways for anyone exposed to AI infrastructure stocks or the broader technology sector. First, artificial intelligence is a transformative force. Its long-term impact on productivity and the economy is not in question. The real debate is about timing and the gap between capital investment and realized returns. Second, history shows that those who build the infrastructure often don't reap the greatest rewards. Instead, future innovators who leverage cheap, depreciated assets typically emerge as the biggest winners. Third, today's warning signs, $162 billion in delayed or canceled data center projects, mounting grid constraints, and the convergence of debt maturities with hardware obsolescence signal a narrowing window for error. Investors must distinguish between the health of the underlying technology and the risks specific to the companies currently betting big on infrastructure. Diversification is crucial. Exposure to broad indices is fundamentally different from concentrated positions in the most leveraged firms. The numbers don't lie. The gap between projected AI revenues and current spending is not speculation. It's arithmetic. Share this analysis with anyone you know investing in AI infrastructure. The risks are real and the clock is ticking.